This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Riding Santa's coattails, the holiday spirit hits Wall Street and stocks take off with a triple-digit gain on the Dow and more records for the other indexes.
Retail rush. Retailers looking to keep the holiday season going as shoppers flock to stores in person and online in the hopes of getting big deals and continuing the spending.
And three of a kind, our market monitor has a trio of big caps he says you need to have in your portfolio for 2014. All that and more for this Thursday, December 26, 2013.
Good evening, everyone. Looks like Santa Claus decided to hang around a bit, dropping off a few late gifts on Wall Street. Stocks rose sharply today with another record close for the Dow and the S&P. For the Dow, it's the 50th record for the year. The blue chip average is on track for its best yearly percentage gain since 1996. Now, driving stocks higher today, some good news about the job market. First-time filings for jobless benefits dropped more than expected. By the closing bell, the Dow jumped triple digits, up another 122 points. The Nasdaq rose 11. The S&P added about 9 points. Over in the bond market, the yield on the 10-year note touched 3% for the first time since September.
Well, our market monitor tonight is here to talk more about the record-setting day on Wall Street and the stocks he's adding to his holdings for 2014. He is Peter Sorrentino, Senior Portfolio Manager at Huntington Asset Advisors. Peter, welcome and good to have you with us. Your prediction for the S&P 500 next year is about 2047. That's roughly 11% higher than it is today. What are you worried about that could cause that prediction not to come true? Is it that earnings won't be as great as you forecast? Is it that the multiple won't expand as much as you foresee? What worries you?
Well, Tyler, you touched on a couple of the key factors right there. When you get to later stages of a market such as this, and we begin to see this take shape over the summer, you go from the value market to a growth market, and that's built on PE expansion. Normally, rising interest rates and PE expansion don't go hand in hand. But we had a collapse in commodity prices this year, kind of the final act of what had been a almost decade-long run for most of them. So that, in our mind, presages a return to higher PEs next year. That means we're going to have a more volatile market. Anytime you get that kind of forward-looking and forward discounting, the market gets more volatile, and we had a sort of dearth of volatility this year. So in our view, that in a market where psychology is fragile, that could be a real issue next year. We could see, again, you talked about the 10-year. Our fear is that if it spikes for some reason on bad news, that also could rattle investor confidence. But we do see earnings growth continuing next year, a lot of very positive fundamentals in the U.S. economy. So it will be a more volatile year, but we think at the end of the year, we actually post some nice returns.
And you have a couple of stocks that you think will post nice returns in the new year. Let's look at some of them. You have Dover as your first pick. What is it that you like about this company?
It's a continuation of a theme we've had for a couple of years now. You're seeing a renaissance in a number of different sectors of the U.S. economy: agriculture, energy, manufacturing. And Dover, behind the scenes, is really built into all of those. And we think that they'll continue to be there. And this is a good market for them. It's not a cheap stock, but it's a very, very profitable company, and it's got the kind of what we think earning potential that will drive the stock price higher in the year ahead.
You like some of the large cap multinationals. That's one of the themes that you're hitting, and John Deere is certainly one of those. What's going to drive it in 2014?
Well, Deere really suffered from the collapse in commodity prices this year. With good harvests around the globe, the price of the commodities drove the stock. Yet Deere's earnings continue to go higher this year. The stock is one of the most profitable in its industry, and yet right now is actually trading at a discount to some of its foreign rivals. If you look at Mahindra, Komatsu, Kubota, Deere is actually trading cheaper than they are, and yet it's by far a much better run, much more profitable company. We think the theme of food and better diet around the globe continues, and Deere is, in our view, the industry leader, and at this price, it's the kind of stock we want to own.
Peter, tell us about IBM. This is another one of your picks. It's had a very rough year. Why do you think it's a buy at $184?
Again, we think we're into the later stages. Technology was a real hit or miss over the last couple of years. The likes of Apple and Facebook getting an awful lot of the attention. Again, here's a very, very profitable company, great margins. It's probably selling at a 30% discount to the likes of Accenture and Hewlett-Packard. So it's the kind of value name, but it's a well-run company, and we think, again, it fits into that renaissance for American manufacturing and American export. And with some of the highlighted security glitches we've seen in recent weeks, we think companies are keenly aware of their vulnerability, and we think they're going to be spending pretty heavily to protect themselves from this kind of intrusions going forward.
All right, Peter, we're short on time. Do you own any of these stocks personally, or do you have them in your portfolios?
We have them in our funds, do not own them personally, and we are less than a 3% holder of all three.
All right, Peter, thank you very much. Happy New Year to you.
Happy New Year to you.
Peter
Thank you.
Sorrentino is with Huntington Asset Advisors.
And 'twas the day after Christmas, and all across the country, it looks like everyone was headed to the big post-holiday sales. At least that's what retailers were hoping. Many shoppers were attacking the sales with gift cards in hand. Target says the day after Christmas is the most popular day to redeem them. And not surprisingly, even upscale stores were running 70% off sales. Julia Borston has more on what retailers are pinning their hopes on.
This mall and others around the country are hopping. Nearly 80% of Americans said they plan to shop post-Christmas end-of-year sales and take advantage of what are some of the deepest discounts in years. So deep, they could discourage consumers from ever wanting to pay full price again.
The prices are much cheaper, compared to prior to Christmas.
I've saved 40% on already knocked off items, so I think that's pretty good.
I mean, I'm getting a better deal on these today.
Many consumers got started yesterday. Christmas Day online sales were up 16.5% over last year, driven by the highest ever mobile purchases, 29% of the day's online sales, following on the trend of online shopping growing 15% this holiday season.
I think the weather, particularly across the Midwest, was pretty nasty over the last week, and people definitely feel more comfortable shopping at home.
But the day after Christmas, consumers head to the malls to return unwanted gifts and cash in those gift cards. Holiday shoppers are expected to spend an average of $163 each on gift cards. That's up 4% from last year for nearly $30 billion total, according to the National Retail Federation. Since gift cards aren't counted as revenue until they're redeemed, retailers hope they'll spend early and spend more than the value of the card.
I'll probably spend the gift cards in the next week, maybe in the next day.
A few gift cards, and I go into these shops.
Nobody gave me a gift card, if you can imagine.
While cashing in those cards is a good thing for retailers, the other big thing shoppers are doing today, returns, isn't great. Some $60 billion in returns are expected this year, according to Liquidity Services, as about a third of all Americans return at least one gift, with a third of those returns completed before the new year. Retailers hoping they'll buy more stuff when they go in for returns. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Although the vast majority of gifts ended up under the tree where they belong, for some people, the Grinch, read that the package delivery company, stole Christmas. That made this a day for damage control. That's because some packages promised for Christmas Eve never arrived. UPS and, to a lesser extent, FedEx underestimated the volume of last-minute online sales, and angry shoppers raged in the Twittersphere. Diana Olick has more.
It was a black eye for Brown.
It's frustrating.
Even the competition was sympathetic.
Everybody had the free express shipping. I think it was a little more than they expected.
But UPS added to its own PR nightmare, claiming just 2 weeks ago that it was more than ready for the Christmas rush.
We continue to become more efficient and use technology on the ground for routing and scheduling so we can, meet increased demand.
UPS had predicted 7.75 million packages would enter its system over the holidays. They handle about 45% of all U.S. packages. What they did not predict was that online sales would jump 37% last weekend. As delays mounted, UPS issued a statement Tuesday saying, "The volume of air packages in our system exceeded the capacity in our network as demand was much greater than the forecast." And then another statement today. UPS apologizes to both shipping and receiving customers who may have delays. Some said bad weather and a shorter holiday season contributed to the trouble, but a jump in mobile shopping may have tipped the balance.
I think you had people trying out, for the first time or one of the first times, purchasing products online via mobile devices, and it accelerated these last-minute purchases. Logistics weren't there to support it in a lot of cases.
The question now is, how much will this affect online retailers like Amazon, which rely so heavily on their carriers?
I think that the ease of shopping online will make people continue to shop online. It's important not to overestimate how significant it is. Online shopping still accounts for only about 15% of retail spending, so most people still hit the stores.
Amazon placed the blame squarely on the carriers, saying in a statement, Amazon fulfillment centers processed and tendered customer orders to delivery carriers on time for holiday delivery. We are reviewing the performance of the delivery carriers. Frustrated online shoppers, of course, chose to vent their frustrations online. Twitter lit up with complaints. The hashtag UPSFail emerged late Christmas Eve, with some calling UPS a Scrooge.
But others defended the drivers and their hard work, clearly remembering another Christmas character who had some delivery issues of his own, but then had this thought: maybe Christmas doesn't come from a store. Maybe Christmas, perhaps, means a little bit more. For Nightly Business Report, I'm Diana Olick in Washington.
Our next guest says retailers and shippers are just beginning to understand the power of online shopping. Joining us now, Tom Blishock. He's the Chief Retail Strategist at Booz & Company. So, Tom, let's look at this new change in behavior, the power of online shopping. What does that mean? Is that going to be good or bad for the players in this space, whether you're a retailer or a shipper?
I think it's going to be great for both the retailer and the shipper. What happened this past weekend was an interesting sort of perfect storm. Lots of shopping online, 3 weekends of bad weather, and people not having enough money toward the end of the month and really shopping over the weekend.
Tom, when you were here last, you suggested that I get the automatic crock pot for Susie. She was thrilled, by the way, so thank you for that observation. What are you hearing about mall traffic and selling today? This is a big day, maybe one of the 4 or 5 biggest of the year.
I was out this morning at 6 a.m. in a Walmart store, which was packed. I went from there to Toys R Us and to Best Buy, Target, etc. Traffic was absolutely phenomenal this morning early as people were searching for great deals for this holiday.
Yeah, but the numbers we've seen early on, 2% up so far for the holiday season. How is this all going to play out when the retailers start reporting their earnings in a couple of weeks?
I think it's going to be a tough period, a tough year. I think that on the previous segment you had, there was a comment about, margins perhaps, and about how profitability is going to be generated. I think this is going to be a tough year at retail. We're going to see a little bit of raise in sales, but we're also going to see some challenges with profits.
Tom, we hear that Amazon, for those people who did not receive their gifts on time as promised, are going to pay $20 in sort of in-kind payment to them. That's going to squeeze their margins, which are not highly squeezable as it is. They're pretty small.
Yeah, I think Amazon is attempting to do what it wants to do best, which is to serve the shopper. By the way, most of the online retailers are trying to do the same thing. But clearly, this glitch in this shipment was something which was unexpected. It's very tough to plan this season.
Tom, let's talk a little bit about 2014. What can we expect? Retailing is an all-year-round kind of a business. Any new trends that we should be looking out for in terms of what retailers are going to be doing?
I think we're going to see about late February some tremendous sales on electronics. Watch smartphones, TVs, personal wrist computers, et cetera, to be a big item. A lot of home appliances will go electronic. Cars will go a lot electronic. 2014 should be a pretty strong electronic year.
Do you see the shipping glitches as anything that will reverse Americans' move towards online shipping or using mobile devices to shop?
Tyler, I don't think so. I think this is a glitch. It was an unexpected glitch this season. I think people are absolutely glued to the online environment going forward.
All right. Well, we're going to leave it there. Tom, thanks so much. Happy holidays. Happy New Year.
Happy holidays. See you.
Tom
Bye.
Blushak, he's with Booz and Company. Tyler?
All right, Susie. President Obama has signed the 2-year compromise budget agreement, the result of bipartisan negotiations that took place earlier this month. The measure will ease automatic spending cuts and reduce the risk of another government shutdown.
And still ahead on the program, merger activity was down, but not out this year. We saw some blockbusters like the mega deal for Verizon Wireless. But our next guest says 2014 will be the year of even bolder ones. He'll tell us why. That's next. Well, talk about a deal. Some travelers who bought tickets on Delta.com this morning got fares for as little as $5. That's because of a computer glitch, and that's where we begin tonight's Market Focus. That error on Delta's website allowed lucky customers to score dirt cheap flights, including $25 round-trip cross-country tickets. Delta fixed the issue and said it doesn't know why and how many tickets were sold, but the company will honor those cheap prices. The mistake didn't weigh on Delta's stock. Shares were up slightly to $27.88. A legal setback for BP related to the 2010 Gulf oil spill. A U.S. court rejected BP's argument that it should not compensate businesses if they can't prove their losses were caused by that oil disaster. The federal judge ruled that the energy giant's new position went against a previous argument. But despite the news, BP shares rose almost 1% to $47.97.
BlackBerry's co-founder Mike Lazaridis cut his stake in the company, sending shares of that smartphone maker way down today. In an SEC filing, Lazaridis, who was considering not long ago a joint bid to take over BlackBerry, also said in that filing he's no longer interested in a buyout. Shares tumbled more than 8.5% to $7.06 at the close. T-Mobile shares were up today on news that Japan's SoftBank is in talks to acquire the wireless carrier. SoftBank reportedly hoping to take a majority stake in T-Mobile through its Sprint subsidiary, which it recently took over. The stock, T-Mobile's that is, up more than 2% to $32.93.
So while we wait for a deal in the telecom space, tech always seems to be attractive for investors. So where might the capital flow in 2014? Josh Lipton asked some of Silicon Valley's top venture capitalists for their best ideas for next year.
2013 was a big year for tech IPOs. The poster child was Twitter. The social network debuted for trading on November 7th. Analysts had expressed caution about the site's valuation, but investors haven't shared in that concern. The stock hit a new record today, and it's up 170% since its IPO. So what could be the next big tech IPO? Scott Cooper is the managing partner at Andreessen Horowitz. He's a fan of Cipher Cloud, which protects data in the cloud.
People are worried about the security of their information when it's living in the cloud. And so Cipher Cloud allows them to effectively encrypt that information when it's out there so that a normal employee obviously can get the information appropriately, but if anybody tried to hack into the system, all they would find would be encrypted data.
Cipher Cloud already has over 1.2 million users. The company raised $30 million from Andreessen Horowitz. Besides cloud computing, another area of interest for investors and entrepreneurs is cybersecurity. Venki Ganesan of Menlo Ventures is playing the theme through BitSight, which rates a company's security on a daily basis and can tell how vulnerable it is to fraud.
BitSight is like Moody's. It essentially gives a score for every company and allows you and the company to know, measure their security, and then over time mitigate any security risk they have.
BitSight raised $24 million from Menlo Ventures and other VCs. Some are worried that Silicon Valley could be heading into another dot-com bubble with surging valuations and a raft of new tech IPO offerings. But the VCs we spoke to didn't share in that concern.
What I try to always tell about technology is that first you have the inventors, then you have the imitators, then you have the idiots. And when the idiots show up, the bubble is in full flow. We are still in the inventors/imitators phase, so I think we have a long ways to go.
So no signs of idiots, at least for now, according to Ganesan, but there is a lot of money chasing a few good ideas. Josh Lipton, Nightly Business Report, Silicon Valley.
2014 could also be a big year for mergers and acquisitions. Robert Profusek is predicting the number of deals could be up by 10%, a big improvement over this year where transactions were down by 6% or more. And Robert is the chairman of the global M&A practice at Jones Day. Robert, welcome. Good to have you with us. How would you rate 2013? Not a great year, obviously, but what will be different in 2014 to make it so much better than you see this one as having been?
Well, the overall environment has been good. There's money everywhere. I mean, the fact that Verizon could raise $50 billion in a week is pretty astonishing, frankly. So, and companies have lots of money and they're looking for growth because even though I think people feel that next year might be better on the growth side, it's still pretty tepid. So they've got to do things. And one of the things you can do is buy. What's been holding things back, though, is aftershocks, I think, from the financial crisis. 2012, it was the EU. This year, it's been Washington. It's been all sorts of things. I think that stuff feels like it's behind us. Nobody is going into a panic modality anymore.
So, Bob, are you saying that the conversation in the boardrooms now is much more confident, or is there still a lot of anxiety? Because there's been cash on the books for a couple of years now. So why will 2014 be the year that they finally go out and do mergers or buy up companies?
Well, there's been a number of pretty significant transactions last year, mostly strategic, though, mergers of equals, Omnicom Publicis, Tokyo Electron, AMD, the Verizon deal itself. So there's been some big strategic things, but what really drives the M&A market is the so-called add-on, not a merger as such, but buying something that fits into your business. And it hasn't been that we've been fearful, we've just lacked confidence. And frankly, almost every other month or so in the last 24, there's been something that's come sideways and sort of knocked the market off course. I think part of it is we just underestimated the impact of the financial crisis. It had lots and lots of aftershocks.
Bob, who's going to be doing the buying and who's going to be doing the selling in 2014?
Well, there's going to be an enormous amount in tech. This was a very good year for tech in terms of acquisitions, not just capital formation. This was mentioned a minute ago. I think we're going to see a lot in the healthcare industry, all across the spectrum, ranging from providers to device manufacturers, to insurers, to everything. The message of the Affordable Care Act is you got to get more cost effective. The way to do that is to merge and reduce excess cost. Secondly, it's a huge story in this country. It's finally been being covered. But energy and energy infrastructure, not really trading oil and gas reserves and that sort of stuff so much, but the infrastructure that is being built out right now is phenomenal. And a lot of the participants in it really don't have the wherewithal on their own to do it.
Bob, what about cross-border deals? We did have that big deal between China and Smithfield Foods. Are we going to be seeing more deals like that?
Well, in a sense, I don't think one of the things about Smithfield was that, there was a little bit, very little bit in the beginning of nationalist pushback because it was almost a $3 billion deal and China buying something in America. Frankly, we have a very substantial foothold in China. Our Chinese clients think of it as a watershed transaction. No, it wasn't a tech deal. No, it wasn't national security or anything. But it was big, and it went through with really not political pushback.
All right. I'm sorry to interrupt, Robert. We have to leave it there as we're up against the clock. But we appreciate your being with us. Thank you for your insights.
You're welcome.
Robert Profusek is chairman of Global M&A at Jones Day.
Tesla shares are up more than fourfold this year, but that's not the only reason the CEO has been a difference maker this year. We'll explain coming up.
Finally tonight, we've been profiling some of this year's most influential people in business and finance, and one of the most visible has certainly been the billionaire inventor Elon Musk. Phil LeBeau with more.
Very opposite. Elon Musk is in a hurry.
I want to be in the middle of the battle.
He's challenging conventional wisdom, showing the world cars can go electric.
He has brought to the American consciousness a
a thought that, in fact, electric vehicles can exist.
Not only exist, but sell in big numbers, more than 20,000 this year, attracting buyers with unique styling and the allure of almost 300 miles on a single charge.
In some respects, Tesla is the equivalent of the moonshot, where he and Tesla are really pushing the paradigms of the industry in terms of how they retail the vehicle, how they develop the vehicle. And interestingly enough, the industry is learning some lessons.
Critics said Musk wouldn't turn a profit, but Tesla has by charging a premium. Critics said you can't drive far in electric cars, so Tesla is building a recharging network coast to coast. And critics said Tesla is a one-trick pony. But Musk has already lined up orders for the Model X crossover utility vehicle coming next year.
Whether or not he's going to be successful, I don't know. I personally believe he's going to run out of money. I personally believe he needs more product.
Now Musk is changing how cars are sold. For decades, automakers have gone through dealers, but Tesla is cutting them out, opening stores in malls where it can sell directly to buyers. Auto dealers have been fighting Elon Musk, saying he's a threat to their companies. And in some cases, they've won, blocking Tesla from selling directly to customers in certain states. But just a few years after many considered Elon Musk and his Model S a quaint little story, he's making everyone think twice. Phil LeBeau, Nightly Business Report, Chicago.
And that is Nightly Business Report for tonight. I'm Susie Garrow. Thanks for watching.
And thanks from me as well. I'm Tyler Mathis. Have a great evening, everybody, and we'll see you back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. Looks like Santa Claus decided to hang around today, dropping off a few late-day gifts on Wall Street. Stocks rose sharply with another record close for the Dow and the S&P 500 index. The Dow jumped 122 points, closing at its 50th record of the year. It's on track for its best yearly percentage gain since 1996. The Nasdaq was up 11 and the S&P added almost 9 points. In the bond market, the yield on the 10-year note touched 3% for the first time since September. And talk about a deal. A computer glitch on Delta.com posted fares as low as $5 today, and some got $25 round-trip cross-country tickets. Delta fixed the issue and said it doesn't know how many tickets were sold, but the airline will honor those cheap prices. Be sure to tune into Nightly Business Report right here on your public television station.